This recording will give you some examples of some typical calculations you will see in capital budgeting. The first one, number 18, is considering a project that requires an investment of $323,000 and would last for 7 years. The incremental annual revenues and expenses generated by the project during those 7 years would be as follows. And you can see here we have an income statement, and we see that we have net operating income of $31,000. Now remember, this income statement is prepared on the accrual basis, so it shows depreciation expense here. The scrap value of the project's assets at the end of the project would be $22,000. The payback period of the project is closest to. So we want to calculate the payback period. And that's going to be equal to my investment required divided by my annual net cash inflow. Initial investment is $323,000. Now we've got a net operating income of $31,000, but we want the cash inflow. So we have to look at our depreciation expense here, $43,000. Since it's a non-cash expense, we want to take out that expense and add it back into net income to come up with what is our net income on a cash basis, which is $74,000. So if we divide this by 74,000, we get 4.4 years. Next question, 19. The company is considering the purchase of a tractor trailer that would cost $126,175. Would also have a useful life of 5 years and would have no salvage value. The tractor trailer would be used in the company's hauling business, resulting in additional net cash inflows of $35,000 per year. The internal rate of return on the investment in the tractor trailer is closest to. So, we want to know what the internal rate of return is. Well, to do that, we first need to calculate our payback period. Or the factor of internal rate of return. And that's the investment required again divided by the annual. Oops, I keep saying nest instead of net. Net cash inflow. So the investment required is the $126,175. The annual net cash inflow was given to us as $35,000. So that would give us 3.605. And that could either be years or the factor if we're trying to find the internal rate of return. So remember, we're talking about the annual net cash flow here. So we want to know what's going to be the annual return that we're going to get. So we need to look at this factor on the present value of annuity table. As soon as you say annual, that is your key to let you know you're looking for annuity, which means you want to receive something every year. So if we look at the tables here, the second table, and you can tell without even a heading that this is the annuity table, because you can see it goes from 0.962 and see how all the factors start to become greater than 1. So we can get all the way down to the bottom here. And so you can see the bottom right goes to 3.99 internally. We're up to 15, 20. So everything is greater than 1 versus the present value of $1. Or lump sum is another way of looking at it. Starts with 0.962, but if you look all over, all the factors are less than 1. So that's how you know you're looking at a present value of $1. Meaning, this table is used when you're looking for a return. Let's say someone passes away and you are inheriting $100,000. So you can this is a present value table, but you can also use it to count. You can also use a table called the future value of $1, and that lump sum says how much is it going to grow in the future just by compounding of interest. Another thing you can think about is I want to know how much I need to put in today that's going to grow to, let's say, $500,000 in 10 years. So I want to know what the present value of that $500,000 is. So the present value is going to use this factor here because it's looking at a large principal growing either to the future value, or you want a certain amount of money in the future and you want to know what do you need to put in the bank today to grow to that amount. Versus annuity, it's going to be the larger factors, and it's going to be based on the fact that you're looking to put a certain amount of money away every month or every year to grow to something. Or you're looking, for example, a lottery, and the lottery actually looks at it and says, okay, I want to be able to give you so much money every year that's going to, by the time, if let's say you won a $10 million lottery, it will grow to $10 million, or you will have earned $10 million. And so it's going to say, how much do I have to give you every year in an annuity that will grow to $30 million? And so it uses the present value of annuity tables to determine that amount. So again, here, remember where we were, we have a factor of 3.605, and we're trying to find out again, and remember, we need to look and remember what was the number of years. The number of years was 5. So we're going to look at our present value of annuities at a factor of 3.605 under the 5 years and see what rate corresponds to that. So 5 years, and again we're looking for 3.605. So 3.605 means we're going to have an internal rate of return of 12%. So 3.605 factor, present value table. Looking at 5 years equals 12%. Next question, number 20. The following data pertain to an investment proposal. So we've got the investment in the project. We're going to purchase some equipment. Shows us the annual net cash inflow, $2,800. Working capital required, $5,000. The salvage value of the equipment, $1,000. And the life of the project is 10 years. The working capital would be released for use elsewhere when the project is completed. So after 10 years, we can use that capital. What is the net present value of the project using a discount rate of 8%? So using each of these, we've got to go through each one of these. And the first one always is we always look at the initial investment first. It's a usage of money, $14,000. We're going to give it right at the beginning of the 10 years. It's not going to grow because we're not investing the $14,000 in earnings. It's going to be to purchase the equipment. So it's one factor of 1, which gives us $14,000. Also, the working capital required. It's $5,000. So it's going to be a factor of 1. So it'll still be $5,000. Now we want to take a look at the inflows and outflows. So the annual net cash inflows. And that's going to be $2,800. It's positive because it's an inflow. And we want the factor. Now, it's annual, and it's for 10 years with a discount rate of 8%. So as soon as you say annual again, that means annuity table. So if we look at the annuity table for 8%, and we're looking for 10 years. So it gives us a factor 6.710. 6.710. that's 18,788. Then we want to look at our salvage value. Which at the end of 10 years, we get the lump sum of our salvage value, which is 1,000. So it's only one time we're getting this, at the end of 10 years. So that means it's going to be the present value table of $1, or the lump sum table, 8%, 10 years. So we're going to go up to the first table, which is the present value table of $1. And it's 8% for 10 years, 0.463. Now the other thing we're going to get at the end of 10 years is our working capital is going to be released. The working capital is 5,000. It's also going to be at the end of the 10 years, so it'll be 0.463. So if we multiply these both out, that's 463 there and 2315 there. Add it up, you get a net present value of 2,566, or answer A. Now the last calculation question has you taking in consideration tax consequences. And it really isn't that much more difficult. You just got to be careful and remember that if you're getting, let's say you were going to earn, somebody's going to give you 10,000 for a product you sell. Well, when you put that revenue on your books, and if your taxes is 30%, you would have income tax of 30% of that, or 3,000. Therefore, your net income after taxes would be 7,000, or you would net 7%. So any expenses you have is at a rate of 30%. Any income you will net 70%. So you'll see how we'll take that in a moment with this information. So the company has provided the following data to be used in evaluating a proposed investment. Initial investment $750, annual cash receipts $563, the life of the project 7 years, annual cash expenses $310. Take the difference, we'll get the annual net cash inflow. Salvage value $75,000, tax rate 30%. For tax purposes, the entire initial investment without any reduction for salvage value will be depreciated over 5 years. So that's our depreciation rate. And the company uses a discount rate of 11%. The net present value of the project is closest to. So we're just going to do this together. So the first thing we want to do is calculate what is my annual net cash receipts. So we had first the annual cash receipts was 563,000. The annual cash expenses was 310,000. Therefore, we're going to have an annual net cash receipt of 253,000. Then we want our annual depreciation deduction, which is going to be equal to the initial investment, which is 750,000, divided by the useful life of 5 years, which is our tax life. So that means we're going to have an annual depreciation of 150,000. So now we're ready to calculate our present value. So first thing we look at is our initial investment. The initial investment is going to be 750,000. Now we're not taxed on that at all because that's just the money going out. So we don't get taxed on what we're giving out. So that's going to be a net present value of $750,000. Then we have the net annual cash receipts, and that we know from above, going over here, was $253,000. Now it's revenue or income, net income after taxes. So that's going to be, we're going to net 70% of that. And then we want to find out what the factor is. Now remember, it's an annual cash flow. And what you want to remember is it's going to be for 7 years. So we want, and then our discount rate is 11%. So if we go to our present value of an annuity, 11%, 7 years, gives me a factor of 4.712. When we multiply that out, that gives us $834,495. The next thing we want to think about is our salvage value. Salvage value is $75,000. Again, it's positive, it's income. We're going to therefore net 70% of that, but we're not going to use the 4.712. The salvage value comes at the end of the 7 years. So we want to go back to our present value tables, but now look at the table for present value of $1. 11%, 7 years, 0.482. So that gives us $25,305. Last thing to think about is our annual depreciation deduction. Now remember, the annual depreciation deduction is $150,000. The deduction is a tax deduction. Remember, tax deductions reduces your income, therefore it reduces how much you have to pay in taxes. So you treat it like it is a depreciation expense. So expenses get treated as with 30% tax rate. We're going to use a different factor though. We're not going to use the 0.482. The depreciation deduction is an annual deduction. So annual means we're going to use the present value of an annuity, but we're also not going to use the 4.712 because remember, this was used for 7 years. We're only taking this for 5 years. So we're going to use the present value of an annuity, but we're going to use the 11% for 5 years because we're only taking depreciation for 5 years. So it's 3.696. And we get 166,320. So our net present value would be 276,120, or answer D.